5 things to consider before investing. 1. Gauge your ability to manage risk. Risk is a component of all investments. Before making an investment, it's critical to understand that you could lose all of your money if you decide to buy assets, such as stocks, bonds, or mutual funds. Your investment in securities is often not insured, in contrast to bank savings. Your initial investment, or principal, could be lost. This is accurate even if you buy your investments through a bank. The potential for a higher investment return is the reward for taking on risk. If you have a financial objective, carefully considering asset classes with higher risk, such as stocks or bonds, as opposed to limiting your investments to assets with lower risk, such as cash equivalents, is likely to result in better financial gains. However, for short-term financial objectives, investing only in cash assets may be beneficial. The main worry for those who invest in cash equivalents is inflation risk, which is the chance that prices could rise faster than returns over time and degrade them. 2. Have a financial plan ready. Consider all of your financial options honestly before making any investment decisions, especially if you've never created a financial plan before. Identifying your objectives and risk tolerance is the first step to successful investing. You can do this on your own or with the assistance of a financial expert. There is no assurance that the investments you make will provide a profit. But if you are informed about saving and investing and follow through with a wise strategy, you ought to be able to achieve financial security over time and profit from the advantages of money management. 3. Have an emergency fund ready. Wise investors place enough cash in a savings vehicle to cover an unexpected expense. Some people make sure they have savings equivalent to up to 6 months of their salary, so they can be certain it will be available when they need it. The ideal sum for you will depend on your financial situation, but as a general rule, you should have 3 to 6 months worth of living expenses saved up. You could require more if you work seasonally, or if it would be difficult to find employment elsewhere. In the event that you do lose your job, you might use the money to cover basic expenses while you look for a new job or to top up your unemployment payments. 4. Pay off your high-interest loans. Paying off any high-interest debt you may have is the only investment approach that pays off as well as it does with less risk. In whatever market environment, paying off the balance in full, as soon as you can, is the smartest course of action if you have credit card debt with a high interest rate. 5. Diversify your investments. Diversifying your investments is one of the most crucial steps you can take to lower the risks associated with investing. Not putting all of your eggs in one basket is just plain sense. You might be able to control your losses and lower the swings in investment returns by choosing the right group of assets within a given asset class without giving up too much potential gain. If you invest a lot of money in shares of your employer's stock or any other stock, you'll be exposed to a lot of investing risk. You'll probably lose a lot of money if that stock performs poorly or if the business fails. We will delve deeper into the advantages of these 5 points in our next video. Like and subscribe for more videos.